Welcome back. Futures this morning are rallying on this, the final trading day before Christmas. The Dow Industrial's up 121, the S&P up 13, and the Nasdaq higher by 42. But of course, it has been a rough year for investors, particularly big tech. The Nasdaq is showing a decline in 2022 of 33%. The S&P 500 down about 20%. The Dow Industrials, even though is negative for the year, is the best performer in 2022. It is down 9%. Joining us right now is U.S. Bank Wealth Management Senior Vice President and Head of Public Markets Group, Lisa Erickson. Lisa, it's great to see you this morning. Thanks so much for being here. How would you assess 2022?
Well, 2022, to your point, was really a difficult market. We went in the year, obviously, on a high note from the good reopening we had in 2021. But as the year progressed and we saw that inflation really was stickier than most of us expected, and the Fed and other central banks globally really needed to restrict monetary policy as a result, we did have this first repricing in markets where we saw multiples go down simply because interest rates were now a better alternative. And then you continue to have other unfortunate shocks such as the Russian-Ukraine war, and that really continued to contribute again to concerns about supply chains as well as what was going on with inflation. So it's been a tough year.
Tough year for sure, and we are expecting some of the trends to continue next year. Now, this morning we'll get the November core PCE index. It's out at 8:30 a.m. Economists are looking for an increase of 0.2% month over month and 4.7% increase year over year. Lisa, we know the Fed is going to continue this interest rate move in 2023. What kind of a new year are you expecting for markets and inflation?
We are going into 2023 with a more cautious outlook. And as we look at it, again, the Fed has been clear that they are continuing to battle inflation as their number one priority. So with that, we're going to continue to see tight monetary policy, even if it's at a slightly lower rate than perhaps the tightening was in 2022. It still will provide a headwind to the U.S. equity market. On top of that, when we look at what's going on in the macro data, our global proprietary health check, as well as that specifically in the U.S., continues to show that a number of macro indicators across the board are showing slowing momentum. And so, again, you already have growth trends decelerating, and on top of that, a still difficult monetary environment.
John Lonsky, jump in.
Well, I would add that, it's too early to assume that these growth trends will not continue to decelerate. I believe that the equity market is going to remain in a type of purgatory until we finally reach that hell of a recession that bottoms out corporate profits as well as brings an end to worry over price inflation. So my sense is it's too early to state with confidence that the equity market has already bottomed. I see some rough times ahead in 2023 with some downside surprises for corporate earnings being delivered by this outright contraction of economic activity that's also referred to as a recession.
Lisa, how would you be invested going into 23, having said all of that?
We are advising our clients to be underweight equities, all other things being equal, again, because of these difficult environmental factors that we're seeing. And we would agree with John that really, as we look at it, one of the key risks going into 2023 is that of really an earnings reset. We haven't seen those particular earnings estimates come down to a great degree. And again, with inflation still at relatively elevated levels and consumer spending slowing as well, we could see, again, those stock prices come down on the back of corporate incomes really coming down.
All right, we'll be watching that. Lisa, it's great to see you this morning. Thanks very much. Lisa Erickson joining us.